Fundsindia's Market Lounge Reloaded. I'm Sharon and I'll be moderating this session. Today we shall discuss decoding banking and financial services sector. Mr. Arun Kumar, our research head, will start the session shortly.
Yeah, thanks a lot, Sharon. Thank you so much, everyone. Broadly, if you really look at it, we have generally not been too great a fan of the sectoral form of investing because, again, one, you need to precisely time the entry and exit. So, as a thumb rule, we have generally avoided taking sectoral calls. So, we have a separate small basket called the opportunities basket where we kind of keep looking out for slightly higher risk opportunities and where we want to be a little more tactical. So this whole idea of going for each and every sector and trying to explain our thought process on how to evaluate the sector mostly fits into how to play that particular bucket. So that's something that we started building out frameworks for in the last 1.5 years. So as a part of it, as and when we find something interesting, we kind of do a small presentation around it. So that's the intent. So the philosophy remains simple, that for the core bucket, we use what we call the 5 finger strategy, where we diversify across 5 different investment styles. And for the tactical portion, we have a wide variety of funds or sectors or segments or styles that we analyze. And we take a call based on where the opportunity is. So we thought banking and financial sectors is at a very interesting time today. And so we just wanted to give you framework on how to think through this sector, and currently is there an opportunity in the sector. So broadly, if you think about it, entire presentation can be summed up in this single slide. If you look at banking broadly all financial services and banking funds, if you look at it, mostly they are heavy on banks. Most funds are probably 80% banks, or even if you look at the index of Nifty financial services index, is almost 80% banks. And if you think about it, be it the mutual fund industry or the insurance industry or the security, mostly banks are almost there. All these segments, banks are there in the top 3. Once you start playing banks, it's not just the lending that you're playing out for. You're also playing mutual funds. You're also playing insurance. You're also playing stocks through security. So more or less, banks are a simpler way to play the entire sector. So which is why almost inevitably banks almost have a 70-80% exposure to any of these, most of these funds. And thereby, once you take a call on banks, you are broadly there in terms of how to evaluate the sector. So most of the presentation will be taking the banking lens. Now, in terms of banks, it's a very simple business. Now, I'm not going into the nitty-gritties, but broadly, the idea is that if you lend 100 rupees, obviously you need to borrow, which comes through our fixed deposit, savings bank account, current account, and all that. So the banks borrow from us, which for us from our lens is actually depositing or saving. But for the bank's lens, it is actually borrowing from us, and then they're lending it out. And obviously, the difference that they make, whatever they pay for FD, is their cost of money for them. And then they give out loans at a much higher interest rates. That differential or the margin is what they make as profits. Now, in that margin, they have to account for all the employee costs, the branch cost, the setup cost, the building cost, and all that will get included in that. And on top of it, the other key cost is not all the loans that they give out comes back. Some of it doesn't come back. Think about, say, what happened to Kingfisher Airlines. And there are always several companies which don't give back the loan amount that they've taken. So which is what happened in the before 2020, almost for 5 years. From 2015, you had a bad NPA cycle where the number of bad loans were increasing a lot. So if this increases a lot, that again eats away a lot of their margin. So broadly, in a banking business, if you have to grow, fairly simple, you give out more loans, and then out of that loans, you try to get your deposits as cheap as possible. So which means you get a higher margin. So more loans is the first lever. The second is better margins. Lower cost of funding is the second lever. And then you reduce the cost of operations using technology. You use lesser branches, or you reduce the employee cost, or you make them more efficient, and then reduce the cost. And the last lever would be the key lever, where you ensure that mostly you are able to recover the loans that you have given back. If the recovery is very low or large portion of what you have lent out doesn't come back, then you have to go through a tough time, because most of your margins will get eaten away, and sometimes you'll also end up with negative profits, right? So this is broadly the framework. So under that framework, if you look at it, the first key thing is that loans have started to pick up. The bad loan phase is behind us, and then the bank balance sheets are strong. So now let's look at individually three broad lenses through which we are looking at. So the first level, the first key insight for us was that, as I told, the first lever is that you need to get the credit growth up, because only if you lend out more, in that you make that margin. So it can only finally come down to your profits. Now, if you look at it between the period of, say, around 14, 15 till almost 20, you had a lean phase of credit growth. So unlike the previous cycle where the credit growth was extremely good, I mean, it's a cycle. Like there are times where credit growth is above average, and then there are times where credit growth is below average. But because it's a cycle, again, after a long period of time, it starts to go back to the above average period. In our sense, the first leg of uptick has already happened, and in our sense, we think that over the next 3 to 5 years, we will see a strong credit cycle happening as this cycle is turning. Now, the next question is, so the chart is clearly showing that there are initial signals of the cycle turning. Now, the key question is, what will drive this cycle over the next few years, and can this cycle survive over a longer term? So that's what we're going to see. Now, we think there are two key enablers for the cycle to turn. I mean, the cycle is already turned. Now, for it to sustain over the next few years, when you say credit cycle, basically you're lending out money. Now, whom do you lend to? Companies, or which is called corporates, or you lend to people like us who are normal retail, right? Now, in terms of corporates, one way to look at it is, where are we in the cycle of corporates? Now, corporates sometimes borrow a lot, and then once they borrow a lot, they get into a trap, and then they get into a deleveraging cycle where they realize that I borrowed a lot, and now I'll have to slowly pay off the loan, clean up my balance sheets. And now, after you cleaned up your balance sheet, you are all set for the next credit cycle. So if you really look at it, till 2006 was the first cycle. You can see from 50% levels, they went almost up to 80% levels of GDP. And currently, and then after that, we saw a long phase of consolidation. Now we are again back to 50% levels, which was what we were in 1999, right? Now the broad setup is that, see, the way to look at cycles is that while you can't precisely time it, you know that we are at the bottom of the cycle. So over the next, say, 5 years, 6 years, 7 years, or over a long time frame, you know that the cycle is good enough to start. And then again, if you look at the overall corporate debt to GDP compared to any other larger, decent sized country, you can see that we are extremely under penetrated compared to any other global. So both from a cycle perspective and from a compared to other other countries, we are at extremely low level. So which means that this can support the next leg of credit cycle. Now, for this to start, the corporate capex has to start, and we are seeing a lot of evidence of the corporate capex starting, because now you can see the new projects announcement trend also starting to pick up in the last few quarters. Same thing is reflecting in, if you look at most of the steel, cement companies, the capacity utilizations have reached a level where they are announcing aggressive capex plans. So you can see that in the last 5 years, the level of capex, and then how suddenly it's jumping over the next 3 years, which is the expected plans that they've given guidance for. Similarly, you can see the same thing happening for cement, the same thing happening for power. And then if you look at the order inflows for L&T, Siemens, Thermax, they were almost 7% for the pre-2020 era. They were almost at 7%. They got stuck for a very, very long time. Now they are averaging close to 25% year on year. So you can see that almost all parameters, this is a very long presentation in itself, but I've just picked up few slides from there. But there are enough signs that corporate capex is picking up. So broadly, when you put all these things together, we are in the bottom of the cycle for corporate debt as a percentage of GDP. Again, globally also, the level of debt is very, very low. And then again, almost all segments are starting to put up capex, and we have The balance sheets are extremely clean. They are the best we've ever seen in the last 15 years. So all these put together, it was only a matter of time. Now that we are seeing enough signals that it has started, now once the cycle starts, then almost everybody starts to join, because otherwise you will get left out. So over the next 2-3 years, we think this is one of the key components or drivers for the credit cycle or the loan cycle to pick up. The second person who goes for a loan is people like us, which is nothing but the household debt to GDP. Again, you can see it's fairly remained flat. It's not as bad as what we saw in corporates. But again, from a global perspective, we are at a very, very low level. Again, if you look at the house loan, home loan as a segment, we're extremely low when compared to any other major global country. So both of these points to the fact that we have a very long runway left. Because if GDP is growing at 12%, these segments will also do the catch up, which means these segments can grow much faster. Now, again, the key, if you look at real estate, is one of the key drivers because if you really think about it, most of our throughout our life, the biggest loan component will probably happen through real estate. So you can see that there is enough evidence. There are prices starting to slowly inch up in a lot of cities, and there is also a lot of data that the number of launches which is there in the top 7 cities, it has gone up. So this is one chart, but again, I've seen it across different cuts and slices of data that broadly this trend is kind of started in the last 1-2 years, and it's also seen in the results of most of the listed real estate players. And again, while the interest rates have gone up, the affordability ratios are still at reasonably low levels. They are nowhere near the top that we saw during the last end of the cycle. So which means that the real estate cycle can be the key driver on the retail side. So broadly, we think the credit growth cycle has turned, which is very good for banks, and it will get supported both by corporate capex starting and the real estate capex starting. So this is our first key insight, right? So this is very positive for banks. And the second thing is, let's say I give higher loans. Now the key point is that if my NPAs or if I'm not getting the loans back, which is my bad loans are increasing, then it eats away all my margins, right? So then it means that I will mostly get into losses. So now this is again a cycle. So you can see the gross NPA cycle. The previous cycle got cleaned up in 2007, 8, 9, 10. Then again, the next cycle started. Probably it should have started in 12, 13, but most banks were pushing away the pain. But then after 2015, Raghuram Rajan said, let's not do this anymore. You guys have to take up the pain. And that is why all banks had a very tough time. But starting 2018, this side started to come down, but still very high levels at that level, at that point in time. So till 20, it was a very tough phase for banks, especially the corporate banks. So any other bank except for HDFC Bank and Kotak Bank had a very tough time during this period. But now, as you can see, they have more or less cleaned up. So which means I am giving higher loans and I am able to capture more of it because my NPAs have dramatically started to come down. And so this is also favoring the banks. The third insight is that during COVID, most banks ended up being very conservative. They thought the problem will continue for a very long time. So they all shored up their balance sheet with raising a lot of funds, right? Now, what happens is that you are only required to have 12% as your capital adequacy ratio. But however, you almost ended up with a buffer of had a historical high level of 17%. So which means that now this is very important because this will only allow you to lend. So basically the banks have enough buffer left so that the next few years of credit run, they can easily support it. So the balance sheets are strong. So putting all these three things together, credit cycle is expected to pick up, driven by corporate capex and real estate. The second part is NPAs are cleaned up. So the bad loan cycle is behind us, which will again aid the margins. And then the banks are also have very strong balance sheet. So put all these three things together, we think it's a great time for banks. Now, this is on the near term or medium term view. Now, the key point is what can happen over the next, say, 7 to 10-year view. Is there something fundamentally supporting the banks? We think there are three things happening. One, as earlier discussed, India is very underpenetrated compared to any other global major country. Now, the key point is that the underpenetration was also primarily because banks found it or banks or NBFCs found it extremely not feasible to go out and lend to a lot of people because most people did not have the required assets. They did not have proper collateral, and the it was all cash transaction. So you need to physically put a person who has to go and collect back the loan. So the cost of lending to a lot of people and getting back the money from them was insanely high, and hence most of the segment had to banks were not able to address them, which meant that they had to go and borrow from money lenders and all that at insanely high rates. Now here is where the whole technology stack part of it comes into play. One Jandan account, so basically bank accounts were opened, your Aadhaar was there, and then mobile is there. So which means that all these three are connected, and eventually this set up the next stage for the UPIs to happen. So you can see how in 2017 the red and blue line was hardly there, but after UPI came, it's almost from 6%, which is almost zero, so hardly anything. Suddenly now it's almost around 60%, and we see the numbers, right? It will only be a matter of time before which it goes to 80-90%. So over a period of time, we will almost, this whole equation will reverse where it's only digital transactions. Now the advantage of digital transactions is that it does three things for banks. One, it gives you decent collateral, which this is a nice slide from Nandan Nilekani's recent presentation. So one, you are able to get the data, and then you are able to because you are getting the, so let's say I pay my maid gets say around 25K working in few houses, right? But the point is the bank can never lend to her because they do not see the fact that she gets paid 25K. Now let's say she is now getting paid through UPI, which is what she's doing. Now over a period of 1-2 years, the bank will suddenly see that, hey, this person is consistently getting 25K every month. So we can easily lend to her, and then whenever she gets paid, we can also take out the money from the bank account, and she will also find the loans to be at a far more cheaper rate, right? So suddenly what will happen, the banks can discover people who are eligible to get loans. They don't need a large collateral. Their digital transactions itself can start to become a proof, and then obviously the startups will build a lot of algorithms to figure out who is the right person to lend and all that. And the best part is you can also collect it digitally. Now the bank sitting at Jammu and Kashmir can probably lend to a person sitting out of Chennai, and then they will also be able to collect the money back. You don't need a physical guy there. Now once all these three comes in, automatically the ability to lend to a lot more people and a lot more lower ticket sizes will start to improve. Now if you look at the data, you can see the blue line, right? It is the rupees, it is loans for less than 10,000. Now you can see how that is dramatically increasing in till FY21, and I don't have the recent data, but this number is only increasing. So which means that now it's a lot more feasible to give a smaller loan and to a larger number of people. So this will be a big trend over the next few years, and there's a lot of infrastructure getting built on the digital side. So in probably 3-4 years, in 1-2 minutes, anybody can take a loan digitally, and the loan repayment can also be done digitally, everything through a simple mobile phone. So this will in my sense, it will just blow lending to a great extent. Not that people were not taking loans earlier, it was just that it was on the unorganized segment. So I think this will be a key long-term driver for loan growth. The second big driver is most banks are now, if you look at Axis Bank, HDFC, ICICI, all of their presentations have a lot of focus on rural. And now because it's far more easier to address rural because you don't need to put I mean, while they are putting branches, the digital tech layer has made it a lot more easier. If you can look at it, almost 65% of households are in rural. But if you look at the banking thing, it's only around 11% is what is the deposit share, and only 8% is the share of credit. So you can see that. So urban is only 35, but it is almost accounting for more than 80% of the banking system. So this entire 65, while obviously it won't volume wise, it will take some time. But the point is, this is a huge untapped segment, which will again lead to a lot of credit growth happening over the next 5. This is again a long-term thing. And then you can see all this evidence that most banks have started talking about going after the rural, where it's predominantly till date, it's only the PSUs who have been ruling the roost there. So this is one more positive for the private banks. And then if you look at it, the other structural theme is that the PSUs to private banks is a theme that's been going on almost for the last 20 years. So you can see how in 2013% of loans were in private. Then it became 1995. In 2010, it became 18. 2015, it became 21. 2020, it became. So every 5 years, you are seeing a shift of this happening. So this was again one more additional kicker for a lot of private sector banks. Obviously, in the short run, but again, if you split the data, you can see SBI has more or less retained its share. It's only the other PSU banks which are losing market share, and most funds predominantly stick to the higher quality PSU names like SBI or Bank of Baroda. So it's only the loss of share has predominantly been from the other PSU banks. So for the, at least for the last 10 years, the SBI has been able to reasonably maintain its market share. So this is another broad theme which will again help the private players in the longer run. And then the third big theme that we are seeing is the incremental shift of preference of saving shifting from physical to financial. Now, obviously, as an industry, we have been seeing significant increase in SIP flows. Like maybe 10 years back, what we got the entire 1 year SIP flows is what we are getting in a single month now. So SIP flows have significantly increased. You have seen the same thing happen in demat account opening. So there's a lot of evidence that this trend is accelerating, and every month you're seeing the SIP flows starting to go up. So this is one more trend that will probably continue over a long period of time. So putting all these three things together, one, there is a large underpenetration, and technology will help to penetrate a faster pace. Rural is one more untapped segment. Then you have this private banks capturing the market share of PSU as a broad theme that continues. Then again, the financial savings is yet another. So if you put all these three things together, these are your long-term drivers, which is again extremely positive for banks and the financial sector as such. And so now putting all this together, what is the current thing? The current now, where is all this leading to? As you can see, once the NPA cycle started to improve from 2018, banks, they have something called return on assets, which is like out of all assets is essentially what they've lent. So this number is very critical, because while you give out your loans, as you increase your loans, this number also has to either stay stagnant or it has to improve, because this is what you capture from your loans. So if you look at the last 3-4 years, you have increased this margin, and at the same time, you have also started to increase your loans, which is a good thing, because you're capturing more of the loans, incremental loans that you are lending as profits. And then ROE is nothing but this ROA, return on assets, that you multiply by how many times you are taking leverage. So broadly, ROE is at 15% is a very, very healthy number. So you can see fundamentally ROAs have improved and your ROEs are high, which means it's very, very good for banks. And then again, if you go back to history, the last time the credit cycle happened between 2002 to 8, the banks grew their profits at 33% per annum over that entire stretch between 2002 to 8. Then if you look at the returns, banking sector gave 5x vis-a-vis 3x for the Nifty. So it was almost, you made 40% per annum returns for that period. So when the credit cycle is in your favor, banks are a great way to play the credit cycle, which is what history tells us. And currently also, if you look at most of the consensus estimates, they're expecting banks to grow at anywhere above upwards of 25% is the expectation. But let's say if we give some margin of error, 20% plus is the earnings growth expected. So now you have, as you saw, the fundamentals are in place, the long-term drivers are in place, the earnings growth expectations are also in place. Now, what about valuations? Thankfully, this is the only segment where, unlike all the other sectors, where the valuations still continue to be reasonable. So you can see price to equity is below historical average. Again, price to book is also below historical average. Now you can look at both Nifty Financial Services and Nifty Banks. Both of this give us the same picture. I've not used those two slides just for simplicity, but again, we had the data. It's almost showing the similar thing. So you have everything in place along with reasonable valuation. So broadly, we think it's all stars are aligning for this segment. So overall, our broad theme is that your economic growth will reasonably remain good over the next few years. Then this under-penetration is a huge theme which will drive more and more loan growth. Then technology and digitalization will help banks lower their cost and to lend at scale. Then the NPA cycle is behind us. Corporate growth, credit growth is picking up, and both your ROE and ROA and profits are improving. then valuations are low, and then we expect valuations to again start to improve at some point in time. And all these will lead to very, very good returns as we saw in the past cycle. So overall, this is the summation of it. Now there are different ways to play it. Our preference would be iProve Banking and Financial Services Fund. It's a fund which has been there for 15 years. It's the largest AEM fund. Again, we like the fact that Shankaran Narain is the CIO, because banking is a segment where if you make some errors, then you get hit really badly. So we want a very conservative and a cautious fund house when you're playing a sectoral theme like this. We like this, but again, if you want, you can also play the simple Nifty banking index as well, or there are other multiple options for this. But broadly, the idea is the theme is looking very, very attractive, and hence if you can, and unlike other themes, you don't need to precisely time it, because broadly the cycle is by our side. So even if you enter gradually over the next 2-3 months, you can easily participate in this over the next 3 to 5 years, and end up making reasonably good returns for your client. So this is the broad theme that we wanted. And why iPro banking? As I broadly said, 6,000 crores in AEM, which means that, and it's run by a very experienced fund manager and a very conservative fund house. The idea of how to deploy it internally, for us, it's 10% of the portfolio can go into this, and within 5% can go now, and the other 2.5 can go if there is a correction of 10-20% from here on. If there's no correction, you stick to the 10%. Or if you're super confident, you can also go for aggressive clients, you can directly go 10% and then play out the next cycle. But generally, we keep a buffer, because once you invest and then if there is a correction, then we have seen that clients become little not angry, but they become a little disappointed. So keeping these kind of buffer of money to invest further helps us give a good experience. And this fund has done reasonably well. On average, it's outperformed Nifty index by almost 4%. And on a 7-year basis, 90% of the times it's outperformed. And it's also done well vis-a-vis the own benchmark. So the broad idea is that we think the banking segment looks very, very attractive, purely going by what we discussed till now. Thank you. Thank you so much.
Thank you all for your valuable time. We are eager to hear about your views on this session. We'll be sharing a link in the chat box for your swift feedback and response. Kindly take 2 minutes of your time to respond to the same. Until we catch up next time, this is Sharon signing off. Have a good day.